And I'm Tim Quast. Thank you for joining the Edge. It's a live discussion. Is this it's not a product demo. I mean, I'm always happy to answer questions about how to use the platform, but generally here, we're here to share with you mechanics so that you can go trade and invest, we hope with success. Let me see if I can swap this mic. And I'll tell you what, let's change the plan, Brian. Let's have
Yeah.
you go first, and in the meantime,
Yep.
I'll see if I can sort this out and swap mics and fix the problem. So I'll do that cleanup again. So Brian Wilson, market strategist, over to you.
Sounds good. Sounds good. Good to see everyone. Welcome to mid-March. It's been a little volatility in the market. We've been talking about that for a while. I'm going to visit a topic that we talked about last week. There's a reason for my madness, and I'll go ahead and share my screen. So those that were here last week, you'll remember this topic. We talked about SPY, and we talked about SPY sentiment hitting 1. Let me show you what this looks like over time. We'll start off just with SPY here, just on the search function. So generally speaking, SPY will stay at 5. It's just a general rule. It's picking up blended products. Think of large cap blend, picking up both growth and value. I'm going to take this all the way back to our maximum range. And I won't spend a lot of time on this because I did cover it last week, but I think it's important to kind of keep in the back of our heads as we kind of march through this year. So this is SPY. This goes back to 2017. Look at sentiment at 5, sentiment at 5. That's the norms for SPY sentiment. It's going to generally stay at 5. You'll have little blips where it moves above. You'll have little blips where it moves below. But once again, you're at 5 as a general rule. Now, when we move below, we don't become fully oversold very often. It happened a little bit in 2018. It happened briefly during the pandemic in 2020, and then it happened in 2022. And I know this view is a little bit difficult to see what's happening. I have it broken out here on a couple of slides. So this was 2018, and thanks for those last week. I had called this a bear market in my original slide. Let's call it a correction. I know bear market is technically down 20%. But if we look at 2018, here's sentiment hitting 1. You'll have pockets of recovery. You can see those pockets of recovery afterwards. But as a general rule, when SPY is becoming fully oversold, it's just not a good environment for pricing for the broad market. So this was 2018, 2022. I put bear market in italics. It came very close to that 20%. But look at, once again, SPY at 1 during the course of the year. Once again, you'll get little pockets of moving higher. But as a general rule, that's just a difficult pricing environment for the market. Now, it differs when you move into bull markets. Look at 2023. The lowest that we hit in 2023 was right here in October. It only got down to 1.8. And when you're in a bull market and sentiment moves below neutral, that becomes a buying opportunity for the market. You can see the market zooming higher there in 23. Look at 24, very similar. The lowest we got was 2.6. Once again, that became a buying opportunity. And let me take it back for a second to 2020. We did hit 1 during 2020. Of course, we had intervention by the Fed, and the market, took off from that point going forward. But as a general rule, when sentiment hits 1, it's not good for the market. During that year, we hit 1 here about a week ago, and we've been stuck at 1 from that point going forward. What's my takeaway? I think be careful this year. I think unless we see some type of intervention, I hope it's not something like 2022. Maybe it's closer to 2018. I think the way that I personally am going to be treating it is I'm going to be taking profits. I expect, that we get these bounces during the course of the year. But I'm going to be quick if I'm trading from a broad market perspective and we get a bounce. I'm going to be quick to take my profits during this year. And Tim might differ a little bit, but that's kind of what I'm looking at. That being said, let's circle back to the broad market look. Obviously, weaker today. A couple things to consider. And if you saw my note this morning, I was all over the map, right? There's a lot of mitigating factors going on right now. But we'll start with one of them is the fact that broad market sentiment right now is approaching this green indicator. Now, what that means is that the whole market becomes oversold. And this is broad market sentiment, is what you're looking at. That's our algorithm for demand in the marketplace. And let's back this up to a 1 year look, and we'll catch a couple of times. So we see sentiment going below one. That was in October. Or excuse me, in December. That's what I circled in the snip this morning. When we move below the green line, the market gets upside. It's just a general rule. Now, sometimes that upside can last for weeks at a time. Sometimes it's like December. You see that brief move higher, brief move higher. You had to be quick during that type of trading. This time sentiment move, when was that? Back in August. That was a more sustainable move going higher. And move back here to June, a sustainable move going higher. But we're very close to oversold conditions. I don't know what happens during this round. Part of the reason that I don't know what happens is because the market is extremely volatile right now. This is a report that we run for our investor relations clients. What I want to show you is the volatility that is presently in the market. This is movement from lows to highs during the course of the day. This is the S&P 500. 3.4% on a 5-day average. There's your norms, 2.3%. That's a 48% jump in volatility. That volatility has not come out of the market yet. It's been pegging at about 45 to 50% really for the last week. SPY, very similar. This is our report for the SPY ETF. Check out this volatility, 2% versus norms of 1%. So the market just continues to be very, very volatile. So we're getting a condition where we're oversold conditions right now are meeting a very volatile market, and and something's got to give. We're either going to continue to press lower, perhaps into expirations, or maybe we start to get a little bit of a bounce like we did yesterday. My fear is that maybe it's something like this. And let me back up or move this look a little closer so we can see it better. I say fear because it would mean that the market moves lower into expirations. So this was December. Notice when we got the bounce, that was right at expirations itself. When does expiration start next week? And you can always look this information up. Excuse me for a second. Just go to Market Structure Edge, and then you can go to Resources, and then the expirations calendar. And we'll be getting the 2026 calendar up pretty soon. The expirations calendar for next week is a little different than normal. And the way that it's different is right here with volatility expirations. That's on a Tuesday next week. If you look at the norms, look at the green here on the calendar, that's normally on Wednesdays. The reason for that being on Tuesday next week is because of the market holiday here, Good Friday later on in April. That adjusted volatility expirations for this cycle. So your takeaway next week Tuesday is VIX expirations, Thursday and Friday, regular expirations activity. And then the 21st, is also S&P quarterly index rebalances. That becomes a very heavy day in terms of trading volume, especially every S&P products are adjusting there on a quarterly basis. So I mentioned the green line. Let's circle back to that for a second. So once again, approaching the green line, approaching oversold conditions, but doing that smack dab in the middle of volatility. I expect volatility to continue, but what I don't know is whether we get some upside volatility next week. Remember, volatility can go both ways. It doesn't just have to be downside conditions. Let me mention one other item here and then kind of my take on what's ahead. I've been talking a little bit about it already. I see some value plays. Now, recognize with value plays, there's inherent risk. There's the potential to make a lot of money on them, and there's the potential that they just fizzle out and don't work at all. You look at big tech. Big tech starting to bounce from oversold conditions. We were 1.1. We're now up to 2 from a sentiment perspective, short volume below 40. That's pretty promising conditions for big tech. Take a look at something I don't mention too often. I think I've mentioned it maybe a couple times in the last 6 to 9 months. Take a look at Bitcoin. This is just a portfolio that I have with a few Bitcoin related companies. Sentiment starting to rise for Bitcoin, short volumes pretty low. Take a look at energy. We have sentiment starting to rise, both with the whole sector and with those that have larger market cap. And take a look at financials, not quite there yet, but getting very oversold. Short or sentiment down to 1.9 for the big guys, and look at that short covering for the big players. So these are some potential value plays, but take it for what it's worth. They may fizzle out, they may not work at all. I do have a couple of energy plays on. I was making money for a couple of days. I'm losing money today. When I set a value play, I'm trying to hold it for 2 or 3 weeks. So there's going to be periods like today, I'm giving up 3 or 4% on a couple of my names. It just comes with the territory because I'm hopefully trying to, gain 15 or 20%. There's an opportunity cost, obviously, that comes into play. Market lower today, coming into options expirations next week, approaching the green line. What am I going to do with today's weakness? I'm going to be a buyer, but I'm going to tread carefully. I don't know if volatility will continue. We didn't talk about this. That's really nice short covering. I'm probably going, whatever position I want to take, maybe I'm buying a quarter position today, knowing that I might need to average down, next Monday, next Tuesday, whatever it might be. So that's how I'm approaching it. I think we are approaching a buying opportunity. Once again, I think these moves higher for the broad market will be short in duration because of what we're seeing with that SPY look. So I think that's it, Tim. Hopefully I didn't confuse anyone too much with with that info.
Okay, let's do a mic check. How is that better? Is that better? No good?
Still a little bit distorted, yeah.
Okay, let me try one more thing. One thing. Let's see.
That sounds better, Tim.
Oh, it does. Okay. Hold on. Interesting. Okay, well, I've figured out what the issue is. Thank you, Brad.
Yeah.
Okay. Yeah, okay. Well, I'll have to be something that I am not by nature, brief. So, and just let me know in the chat if there's an issue with this thing. I had to go back to the old technology. Okay, so let me share my desktop. I'm going to hit some key points. First off, why does the market behave this way? Rather than take, oops, hang on, just got rid of my camera, didn't I? I warned you, right, that there could be consequences. I'll turn the camera on in just a moment. So rather than take you through this, I wrote Wednesday at the Modern IR. So you can go to modernir.com. That's the business I've run for 20 years. And read this week's blog. I talk about what is behind these moves. You could say, well, Tim, it's just, it's all this uncertainty about tariffs. Well, it's certainly that is an input, but the probability that the market would become volatile goes much further back. I said back in December, you who attend these things know that I actually started some short betting all the way back around Thanksgiving because I thought, okay, well, you look at the data, you look at the demand, supply, and volatility. Those are the things I always come back to. I'm going to move away from this. That when demand stalls and the trend in supply rises and volatility increases, the probability that the market becomes unstable rises. It becomes, it's not perfectly predictable. That's very difficult to perfectly predict these things, but certainly I want to remind you that these are things that are measurable and observable, and they can help you understand what's coming. And so to me, these are simply conditions that reflect how the market works. There's an awful lot of risk management. There's an over-reliance on ETFs. ETFs depend on a stable underlying basket of equities for prices. Things need to move, as Brian pointed out, 2.3%. Really, if it's already that volatility was creeping into that 200-day read. Because if you back up further, it's 2 to 2.2% in the underlying basket of S&P 500 stocks. And that's very important, as I've explained before, for the folks who need to track a benchmark. If you have more than 2% variance versus what you're trying to track, it gets difficult. You can get in trouble with the regulators. The wholesalers who sell products to all the financial advisors may not sell your product, so then you can't raise funds. All those things matter because they reflect the way that the market works today. And so much of the volume depends on that. So we could expect, as I wrote February 25th, the potential for a major vibrating volatility event, as I called it. And so these things, to me, they're consequences of a breakdown in the central things that the market depends on for its prices. And whether tariffs or this thing or that thing, to what degree are those inputs, or is it just something that is going to happen at a certain period of time? Well, read that blog, and that's my view on it. The next thing I want to talk about briefly here, because I said I would, is Tesla. I said in the Monday note that I would address this here. When do you buy Tesla? And if you could go profile this, and it's kind of interesting to see when it's best to do that. The profiler is a very blunt instrument, but here's the demand supply equation in Tesla right now. There is no demand. I mean, the supply is fine, but these are not the conditions that tend to produce rising prices. If you have flat demand and flat supply, prices are likely to be flat too. I don't look at this and say it's bad, but it's certainly not the kind of condition that produces a reliable return. If we back this, you back this whole thing up. Let's go do this. roughly a year, not quite. I mean, I'm doing this on the fly. If you simply owned Tesla when it's above 5, it's almost all you have to do. So in the trailing 238 trading days, if you owned it the 141 days where it was above 5, you could make 85%. versus 42% if you bought and held it for 238 days. It's an indication, that so if it's not at 5 or higher, don't own it. It's a statistical read, but it's a huge advantage over everyone else who's trying to say, well, if it gets to 200, I'm buying. Well, of what significance is 200? 200 is just a price set by machines. Most of the prices are not set by people who are looking at multiples of earnings. Most of the prices are set by machines that look about 400 milliseconds ahead at what the demand supply balance is. So you have to realize that. That's why when everybody's inputs are measured and we see that everybody becomes a buyer because it rises over 5, okay, we'll buy it. We can observe everybody else's behavior. I think that that is a much more effective way to do it. And not all stocks will manifest that way. There are things that you should buy at 1 and sell at 10. And that's tend to be momentum stocks. The fact that you can own Tesla when it's over 5 tells you it's a core equity. It is a large cap value and growth. It's a large cap blend equity. That's the way that the market works. That is what 60 some percent of all equity assets in retirement accounts are in. Passive large cap blend, value and growth, things that spend a lot of time over 5. Which leads me to the next thing. If we look at daily trading ideas, what
Hey,
do you
Tim,
do with?
Tim, briefly before you go on to the next thing,
Yep,
that concept of things staying at 5, I didn't do a good job of explaining that when I was talking about SPY. Do you
yep,
mind briefly explaining why SPY tends to stay at 5 as a general rule?
yes, because SPY is a measure of the S&P 500, which is what? It's passive large cap blend. It's value and growth. And so it's necessarily going to spend a lot of time at 5. And when it deteriorates below that, as Brian pointed out very effectively, it's one of the things we looked at. That tells you the flows have slowed. It's not a predictive indicator to me. SPY. By the time that happens, it's too late. That's why we use broad sentiment. But it certainly explains the environment that we're in. So that's why it spends most of the time at 5 because it is a measure of precisely what we're doing in our retirement accounts. And you look at the blend of things that we have and all these instruments we use, this is what we do. And it's also why you're better off. If you're long term, just use that, right? I say modulate your exposure. I mentioned this last week that I modulate the exposure my advisors use. I can say, look, I don't want us deploying more capital right now because the market was very likely to decline, and I would rather buy it down 10 or 15% than buy it at the top. But I'm still going to put money to work generally in the S&P 500. Why? Because it's 90% of market cap, give or take, maybe slightly under that, and it's passive large cap blend. It's where all the money is. I'm simply going where the money is because that's what causes values to rise. It isn't financial returns per se in the market now, just a fact. Generally, it is because you have a large liquid product that produces the return that the market delivers. That is what BlackRock buys. BlackRock does not buy stories, it buys the herd. It doesn't buy alpha, outperformance versus the same risk everybody else is taking. It buys beta, the benchmark, the movement of the ocean, because that's what it says it does, right? So, all right. And if they're the ones getting all the money, if $2 trillion went to ETFs, if you include the conversion from mutual funds, Investment Company Institute data, we track it every month, over the last year, well, probably that's what we should do. And it costs 4 basis points. IVV, VOO, SPY. SPY is actually more expensive than IVV and VOO. Those are, very inexpensive mechanisms that will reflect these things. Now, the only thing we do differently is modulate exposure, but that's the difference between doing what everybody else does and outperforming. Going quickly to daily trading ideas. A question I get all the time in email is, well, how do you pick out which one? Which thing do you favor over something else? Do you buy the highest probabilities? Well, all of these are a herd in a sense. They all manifest the same characteristics, just with variable volatility. The higher the volatility, the greater your risk, but also the greater reward, right? That's why we do it. So if you look at it and say, well, you could make 11.5% in MicroStrategy, the probability say you could capture part of that, right? We're after a piece of that all the time. I always say 2% because that's what the market moves. If the market's moving 3.4%, well, we can probably capture more. And it's not a perfect read, but if you have a chance to be in this entry range, and you have a horizon of 1 to 5 days, the probability is very much in your favor. Now you have to be aware of the broad conditions. Now those will dampen returns. But if you just can, I don't put any thought into it. If there are 8 of them, and I go down the list and I'm in the entry range in something, I take it. It's not really more complicated to me than that. You could have done that today. The stock dropped into the entry range, and literally in an hour, you could have made your 2%. And that's how much prices move around. So it doesn't always work out that way, but there's a high statistical probability, and that's what it's doing. If you look at low volatility, I don't spend a whole lot of I don't expend a lot of time thinking about these things because that's what we build machines to do. We build machines so that we don't have to do that. Don't have to go study patterns and read a bunch of information. The machines have already incorporated the regulations that govern how stocks are priced, routed, and executed. Well, that's the core of the market. So once again, and if I'm going to low volatility, I'm just going to take what it gives. And by the way, as I've pointed out, all of these have been very good uh, uh, things to hold in a low volatility portfolio year to date, nearly all of them. But again, I don't look at any particular thing. I look at the entry range, right? Is this stock in the entry range? Okay, well then I'll use that. Now, when there aren't very many, I realize that the odds aren't quite as good. I own MRK. It was in the momentum portfolio. It's already out, and I've got stops and limits on it. So we'll see how that goes. Broad market, I actually short SVOL is it's from Simplify Asset Management. Mike Green, who's a principal there, was at the demo last week. I don't use it for that reason, but it's a way to short volatility. It's not working today. I'm a little early, and I don't know. We'll see. I will take the risk that the market offers. So right now, I'm willing to risk 3%. It's 3.4% or so in the S&P 500. When it's 2%, that's all I'm going to risk. And if I execute a plan that's hedged, long and short, I already limited out of my short position today because I always have a hedge. And okay, if that hits my target, I'll take the gain on the hedge. And you say, well, now you're exposed. Yeah, but I also know the whole condition of the market, and there's a certain amount of risk I'm willing to take. And that MRK, I'm right basically in the entry range at present. Now I don't know. I've owned it for a day and a half, so I know I've got a little range. Maybe tomorrow it's there. Maybe I move on. But I'm always using the probabilities, and I do, and it's not a mystery to me what I'm doing. The reason I will shift here to potentially betting more long is for the 2 reasons really that Brian mentioned. A, you have a sharp retreat in supply market wide. It's not awesome, and I'll point that out to finish. And then on the demand side, we're all the way near the green line, 4.1. And options expire next week. I thought that we probably would get a bounce sometime this week, and we've still got one shot, right? still one more day to go, and we might, because this is how quantitative traders think. I put quotes around think. They're going to look at what stuff offers a spread. And there is absolutely a spread in options right now that expire next week. So would someone come along and take advantage of that? Well, it's a probability, and it's reflected in this data. The fact that this is a steep decline on the supply side tells us the people who sold those rights have hedged themselves to the upside. Now, they may be wrong, but there's a lot of educated people, very smart people, people with great risk management systems and data and experience and big models who did that. So the beautiful thing is I don't have to have done all that and invested all that money. All I need to do is look at their behavior as manifested in demand and supply, and we know that there's a pretty good probability. You just have to be prepared that when there is a probability, it also means there is always the offsetting probability that it will be wrong, and you just have to be prepared for that so that you always are hedged. To me, I think that that's important. I will often trade long and short with the movement and volatility as my target. And I get teased. A friend of mine said he was talking about somebody else who's, I think I shared this. He maybe I did, maybe I didn't. Last week, my friends were riding on the ski lift, and he says, "I've got this friend. He trades options volatility. What the heck is that?" And so you feel a little sheepish. I didn't say, well, I will do that too. Not options volatility. I like market volatility because it is a byproduct of the rules. The bid and the offer spread, the way that baskets all have to be coordinated for index funds and exchange traded funds, and everybody relies on that. It creates asymmetries that we can take advantage of. Do I think that it's great that we can trade volatility? Not really, but it's what the market offers, so we use it. And that's how I think about it. Okay, so last two things. A, buying in the last 10 minutes. I should point out that in the last 10 minutes, really in the closing auction, the exchanges charge both sides of the trade. They don't do that the whole rest of the time. That's the maker taker model. The exchanges will pay high speed traders like Citadel to make and take liquidity. So paid to furnish a price and paid to consume a price. Why? So the exchange will have the best bid and offer. But in the closing auction, the reason I mentioned this is you can have a cost. Now, as a trader, if you have a lot of orders in the, if it's a limiter market on the open or a limiter market on the close, you can end up, if it's a certain, like more than 10% of your overall trading volume, you could end up with a charge. They will pass the charge that the NYSE and the NASDAQ and so on are charging. I just mentioned that. So I'm not doing that so much that it causes my volume generally to be skewed. But if I'm going to enter trades, I like to do it then because, as I've said before, I didn't have to risk my capital all day long, just the last 10 minutes. And then it resets the next day, and I'm banking on the probabilities delivering to me what may come based on the demand, supply, and volatility reads that we've got. Okay, now the last thing is to talk quickly. And Brian, what's ahead? I think that you look at these conditions, and I agree with you, Brian, that these are the conditions that, to me, we anticipated. These are conditions that you get in a developing bear market. I don't know what's going to happen, but what the data indicated has indeed happened. And I think you can get sharp moves, and it could happen in the next few days where all the talking heads stop talking about the pressure in the markets, and then wham, shoe number 2 hits right out the other side of options expirations. Why? Because demand is generally not good. You can see that all the way from here to present. Demand is not good. If you took an average read in here, it's about 5. Well, as I've said, a market perfectly balanced with rising supply too is likely to deteriorate because of the bid offer spread. So unless money comes relentlessly in, it's going to be hard for this market to deliver returns. And but back to Brian's point about SPY, this is how you can see it. You can see that the flows to passive large cap blend value and growth has definitely slowed. Now it might recover at options expirations and index rebalances. There may be a lot of people like me who will say, I'm putting some more money, I've got some money that has to be deployed, and I give my, the managers of those resources some range, some latitude. Like, I'd like it to be down at least 10% before you deploy that. Well, it could get, deployed today. So that doesn't, could go down further, right? We don't know what's going to happen, but we know that this condition has not happened since 2022. And it's just good to be aware of that. There are always things to trade. There's always an understanding of where we are. That's huge advantage that you have of seeing demand and supply all the time is something that everybody else does not have. Everybody's looking at technical signals, 200-day moving average. Oh, we broke down through 200-day. It's just a read of previous prices. It's not very helpful to me. It doesn't tell you anything about what's going to occur, whereas demand and supply do. And you can look across your dashboard, as Brian did very well, to see where it is. I look at big tech. Wow, it's on one hand an awesome entry, but the other side, I don't know. The supply side doesn't look great. You look at mega caps. Here's a lot of the market cap. 2/3 of the market cap anyway. And I look at this and say, well, it's not awesome. I mean, you can look all across your dashboard and go, I don't like some of the trends that are developing. There's a lot of this where demand has bottomed and is starting to rise, but so is the supply side. Well, then that undermines the opportunity. And you could look everywhere and see, well, it's not a trend yet, but I look at that condition, things like this, gold, that looks pretty good, but there's a lot of little upticks on the supply side, even large caps here. 355 stocks from 20 to 100 billion of market cap. It's just a tranche. And you look at that and say, well, I mean, that's the dip that we see in the broad market too, but now it's picking up again. I don't know. And that's where Brian arrived, so that we see the very same thing here. So then what do you do? Well, unless the data say otherwise, I will continue to emphasize longer term, low volatility stocks that have less than 2.2% volatility, because that's where the money's going to crowd, and short-term trading, long and short volatility. That's where you arrive to me, and we'll keep you informed on that. Okay, that's all I've got.
Tim, a couple questions came in towards the end here, and I'm not sure if we have time to address them or not. One was, how might a government shutdown throw market structure out the window?
I don't know if it will. It's not highly correlated. A downgrade in U.S. debt is much more highly correlated. There was a downgrade of U.S. debt in April of 2010, and we had the flash crash on May 6, 2010. The relationship between the euro and the dollar, that can be an issue. I mean, you have to ask yourself, why, if the Europeans are printing euros, which is what they're doing, increasing defense expenditures, doing stimulus, why would the dollar sink versus the euro? Because they're selling dollars. We have the only reserve currency. We'll also tell you those things will snap back. The dollar will rise at some forward point. That to me would be more damaging. I certainly could be wrong about that, but I'm not sure a government shutdown really matters that much. And wouldn't it be funny if the market goes up 2.5% and the government, when the government's shut down, and all it is market structure and options expirations, right? So I put a lot more weight on those things.
Mhm.
But market sentiment, actual demand level. How do you
Yep.
interpret the difference, Pam? Let me see if I can understand this. How do you interpret the difference between market sentiment versus actual demand level? You may have to explain that one to me, Pam. I'm not sure. SPX crossed on the demand chart. SPX crossed 55.32 earlier today. I don't know, Brad. Is it statistically meaningful? People talk about support and resistance levels. Are they reliable? I just say I'm not sure about that. Here, I realize my camera's off. I listen to the technicians and I find it interesting, but I don't find that those are necessarily predictive, and it's what I know about prices. I think I shared with you a long time ago. I'm checking the time. That I met with a high frequency trader in our offices. This was years ago. He was, I got to know him and we had talked, and he worked in the market structure group at the Chicago Fed and at a high frequency trading firm. And one of the resonant things that he said to me is at the tick level, there is zero correlation. There is no correlation in anything. So translating that into English, what he's saying is prices offer no correlative value. And yet that's what we're all looking at. It's why we say don't trade price. If a high frequency trader is telling me prices have zero correlating value, maybe we should pay attention to that because they set 90+% of prices. And if they are trying to hide everything, algorithms are designed to deceive. I told you that story, didn't I? And if you're new, I'll share it very quickly. There was a guy who did a TED Talk, and he said, I was sitting on a flight one time next to a guy who said he worked for a high frequency trader. And his background was that he was in intelligence for the Russian military. And he said, we use the same principles in high frequency trading that we did in the Russian military. The Americans like to make their aircraft look like flocks of birds to deceive our radar. So we looked for flocks of birds with electronic signals, right? He said it's the very same thing. How do you find out where an order is? Well, you look for stuff. And with algorithms, you're deceiving people. You're making buying look like selling and selling look like buying. Well, what do we use for technical signals? Price movements. Well, how do you know you're not getting fooled? This to me is why there are very few rich technical traders. It's why I say take a long step back away from that. What you cannot hide is demand and supply. What you cannot hide is volatility. We can measure all that stuff. Is it perfect? No, but it's vastly superior. We're not going to be fooled by algorithms making birds look like, planes look like flocks of birds. We're not going to be fooled. So that's what I feel about how I feel about that. Is 10%, I satisfy my advisors is what I do because they always want a number. Well, what is it? Is it 10%? Is it 20%? I'd like, okay, fine, take 10%. It's not really if it were up to me, I would say when demand bottoms and supply declines, then I want to put money to work. But that's, they can't deal with that. So, and I've got them doing stuff because I can't do everything. So I just give them a number. That's what I do. Okay, Pam, demand and supply. I'm not sure that I answered that question, and I know we're long. Apologies for that. See, I'm not able to be brief. Demand and supply. The real. I mean, to me, if you're talking about here's the value 4.1. I'm still confused on the difference. So if I look at, I mean, this is a running scale that will tell us what the 5-day rolling average is. And our aim with this is to be predictive. We want to know what's coming based on what has occurred. And so, to me, this simply says we are at a green line right into options expirations. What tends to happen? Well, you can look back here at what happened. The market rose. Now, I'm not saying that's going to happen, but it could be pretty dramatic. Because back here we had rising supply. Right now we have sharply falling supply and demand hitting the green line right into options expirations. Could we get a pretty good juiced market? We could. And this is why I say, how would the talking heads explain it if the government shuts down and the Dow goes up 1,000 points? Right? Like, whoa, maybe we should shut the government down more often. But really, it would be market structure. Now, again, I'm not saying that's going to happen. I could look at that supply trend that you see those little tick ups in supply all across the dashboard and say that may not happen. But I do think it's why I did it, that the market could suddenly move. Then I think we have all the characteristics of a bear market. So we could go down substantially more before this is finished. And again, we'll just watch the data. It will be very apparent to us in the data what the risks are and what the opportunities are. And maybe I'll stop there because I can't offer anything else of higher value than that. Any last word? Okay, well, let's call it and we'll see where we are next Thursday. Look forward to I'll be here. I've got 5 more skiing days. I don't want to fall down right now because I've got a pretty good hematoma on my hip, but I should be fine. I want to get 5 more skiing days in. We're supposed to get snow tomorrow. Looks like, I mean, it's kind of beautiful behind me right now, but we should get our last big ski opportunity of the year, I'm hoping. And then I'm off, by the way. I'm going to go sailing in the Grenadines, which is my custom. And, you got to leave Steamboat and go warm up. So we'll be in St. Vincent and the Grenadines on a big boat with a handful of friends the 25th through April 6th. So Brian will give you vastly more value than I can during that period of time. All right, everybody, have a good weekend. Nice to see you. Thank you. Thank you for the well wishes too. I appreciate it. Yeah, thanks.